Everyone. Welcome to our first-time homebuyer workshop in partnership with Sac State Alumni and Athletics. My name is Jason Maida. Great to be with all of you this evening. Really excited to be able to bring this workshop to you. So we generally teach this class 4 times a year in partnership with the Sac State Alum. I know we were kind of a little delayed on this class because we had some scheduling conflicts, but really excited to bring this to you. And it's a really great time to have this conversation. A lot of great things to share with you, especially with kind of what's going on in the housing market right now, what's happening with interest rates. And, many of you that are joining tonight's class might be preparing for this major financial decision as you enter 2026. Tonight, we also have a special guest joining us, Leanne Walker from CalHFA, which you're going to learn a little bit more about the CalHFA home products later on in tonight's class. So that's products designed to support first-time home buyers that are low to moderate income families in pursuit of home ownership. So I'll turn it over to Leanne later on in tonight's class. As we go through tonight's class, I just want to let you guys know that we are recording our session, and we're going to have our recorded session up on our YouTube channel tomorrow morning. We're also going to share back all of our slides from tonight's session. So you'll be able to kind of take a look at some notes. If you have some questions or just want to refer back to your notes, you'll certainly be able to do that. If you do have questions for myself or Leanne later in tonight's class, feel free to use the chat function or Q&A, and then we'll answer those questions on air for you. So we really like to make these sessions very interactive. I know there's a lot of great questions that come out of these sessions, and just want to make sure that we get you all the information that you need to make a really great financial decision in home ownership. Well, I just want to again introduce myself. My name is Jason Maida. I work for an organization called APM, or American Pacific Mortgage. We are a nationwide direct lender. We're actually the 9th largest lender in the country, and our team in particular specializes in really providing homebuyer education to our local communities around home ownership. We believe this is a major financial decision for our clients, and so we partner with schools like Sac State Alumni and other schools to help bring this content to our local communities. Now, in tonight's class, we're going to go through a few different topics, which will include, like I mentioned earlier, the housing market, kind of what's happening with that. We're going to talk a little bit about interest rates and projections for interest rates, as well as look at things like budgeting for home ownership. We're going to walk you through what we call a rent versus buying calculator to kind of look at renting versus what does it look like from an ownership perspective. Also want to talk a little bit about credit, how we can kind of help make sure our credit's best positioned to prepare ourselves for buying. We'll also take a look at loan programs that are available to you. And then from there, we'll kind of talk a little bit about savings for home ownership. Savings for home ownership can be one of the bigger challenges for some of our first-time home buyers. And, we're going to kind of build a plan to help get us to maybe a goal when it relates to savings. And as I mentioned earlier, Leanne's going to talk to us a little bit about CalHFA first-time buyer programs later on in tonight's session. So we'll carve out some time to talk a little bit about what's happening at CalHFA and some of the products that can help you maybe close the gap when it comes to some of the assets that you'll need to purchase a home. And then one of our most important parts of our session today is to talk a little bit about the buying process. I get a lot of questions from our clients that I work with in the process is, what does it look like for me to go from, hey, I'm interested in a home, to getting the keys to my house? So obviously you're going to learn a lot of great tips and resources in tonight's class, but I want to give you an idea of where do I go from here after attending tonight's class? All right. So that's our plan. I really appreciate you spending time. I know there's other things you could probably do on a Thursday night, but hopefully you'll get a great amount of takeaways from the session that we're going to provide to you now. Well, let's go ahead and dive in, and let's start talking a little bit about, does buying make sense for me? You've heard me already mention a couple times that it's probably going to be one of the biggest financial decisions you make. So when we think about purchasing a home, there's a lot of great benefits that come along with home ownership versus kind of doing what I'm still doing today, which is renting, right? When we think about home ownership, there's the ability to be able to kind of control more of our housing expenses when we're homeowners. So we don't have to worry about the landlord coming to us and saying, hey, guess what? Your rent is now going up $200 a month next year when you renew your lease. And, a lot of our buyers that own homes today, and we're seeing some changes in the interest rate climate, are going to consider refinancing their homes, which basically means I'm going to take my current interest rate. Market rates are now lower than what I bought at, and now I'm going to try to refinance my home in order to improve my monthly outgo. Right? So that can happen with home ownership. Now, this is an asset for us that can grow over time. So if I buy my home at a certain price point, as that home goes up in value, as I pay down my mortgage, Now I create home equity for myself. And for most of us across the country that are homeowners, that's probably our number one asset next to maybe your retirements or 401k accounts. So it's a big deal for you, and that asset can really work for you. Homeownership has the opportunity to create generational wealth for families, and that's really a big deal. And that's what we're really passionate about. Not only creating affordability, but creating generational wealth for families. There's also tax benefits that come along with owning a home. So when you own a home, you have potential tax deductibility of mortgage interest. And then when you decide to make energy efficient improvements to your home, you can also create tax deductibility opportunities for you as well. So, when I think about home ownership for home buyers, it's not necessarily a fair comparison to say, hey, I'm paying $2,500 in rent, so that's going to necessarily equate to $2,500 in mortgage, because there's a lot of great elements that come into homeownership that I don't get to take or participate in as a renter. To kind of illustrate that point, I thought I could walk you guys through a really quick calculator that's available on our website. It's called our rent versus buying calculator. And there's several different calculators you can use, but I think this calculator kind of helps illustrate those benefits of homeownership as you're considering that versus continuing to rent. So I want to just walk our class through this calculator. I would encourage you, if you have some time, maybe you're having a kind of a relaxing weekend and you want to kind of run through some budgeting for yourself in homeownership, take a look at one of these calculators. I think you'll find it to be pretty helpful. So if we looked at a scenario that we put together for a client here, we have someone that's buying a house for $450,000, and they're going to put the minimum down payment of 3% for a first-time buyer program. Now that would equate to financing 97% of the purchase price, which you can see here. We also plugged in an interest rate of 6.125, someone that's going to do a fixed term loan for 30 years. And then we also made the assumption that they're going to buy sometime in December, right? Now, when we put down less than 20% to buy a home, there's a thing called mortgage insurance. And that does vary based upon credit score and what my down payment is and how much I finance. We're going to talk more about mortgage insurance later in our session tonight. And then we have homeowners insurance estimates. We have taxes, so property taxes that go to the local county assessor's office. And then for some of us that might be thinking about buying a condo, maybe a townhouse, there would be HOA dues in that case. And then one of the components that we want to think about with homeownership is from a tax perspective, like I mentioned earlier. So what tax bracket am I in? How much is it going to cost for me to maintain my home? What's it going to cost for me to sell my home? So I own my home. 7 years from now, I want to sell my house. What does that look like? And then we factor in appreciation of my home. And then finally, we're going to compare that to renting. So in this scenario that I put together for you guys, we have someone that's paying $2,000 a month in rent. They have renter's insurance costs. They have, rental uptick in cost, right? So we put rent appreciation. So we're assuming that, next year my rent's going to go up, say $40 a month. So not huge, but certainly changes the budget. So let's see what that looks like then when we compare that to owning. So renting versus owning. Essentially what this calculator tells us is that after 4 years, this buyer breaks even by owning a home versus continuing to rent. So that's a pretty short amount of time. So when we think about, how much I'm going to pay down my principal balance, my home's going to hopefully appreciate over those 4 years, and the tax deductibility benefits, it's about a 4-year break even. Now let's stretch that timeline out even further, right? So now I own my home for 10 years. Now I have a gain opportunity of $82,000 of owning my home versus continuing to rent. Continue to pay my rent for $2,000 a month, increases every year, versus I pay a mortgage payment, probably a little bit higher than I'm paying today, but I have that upside opportunity of $82,000 spread over the next 10 years. Now, that also includes home equity that rises to maybe $238,000. So I encourage our class to kind of think through that a little bit more when you consider home ownership. Obviously, I understand this is a major financial move for all of us, but I think understanding what the upside looks like of ownership is really a big part of that decisioning process. All right, so as we consider home ownership and that decision, we got to think about what's the housing market doing right now, right? Well, Sacramento is still a very attractive market to many, even in a high interest rate environment. We see a lot of migration from the Bay Area still in the Sacramento market. I think a lot of people still think Sacramento is a super affordable market. That has changed a lot. You can see that witnessed by the median sales price in Sacramento is now at $496,000. And so that has changed a lot. The average time on market looks a lot different here in Sacramento than other parts of the country. So we still don't have a lot of supply out in the Sacramento market, although it's improved a lot over the last couple of years. So you can see the average day on market is 29 days. That is improving a bit. And you're seeing also prices starting to kind of uptick a little bit in Sacramento as well. So not a huge amount. The markets in general cycle down in the fall and winter times. We usually see a bigger uptick in homebuyer activity April to about August. But honestly, I don't think this housing market's going to look that way in what the fourth quarter, excuse me, the fourth quarter that we're in right now, because we are starting to see interest rates drift lower. It is starting to spark more buyer activity in market. And, there still isn't really enough supply to support that buyer activity. We'll have to see what that happens as we move into 2026. But, I think in general, the Sacramento market has pivoted a little bit. I wouldn't call it a buyer's market here in Sacramento. It's still, probably still teetering in maybe the seller's market to a certain extent. But we are still seeing price cuts out there on certain listings that have been out there longer than expected. We are seeing sellers that are willing to make concessions on either price or contributions to the closing costs. We call those seller concessions. In 46% of all transactions being done across the country, there is some type of seller concession happening right now. So other parts of the country, I think most of us are from Sacramento in today's session, but other parts of the country like Texas and Florida and Colorado, Georgia, they're seeing huge supply in their housing market, which is clearly a buyer's market. But, we're in a different space here in California and obviously in Sacramento. Now, interest rates will influence buyer activity. And so we're having a nice little kind of trend happening in interest rates. Just about almost 4 weeks ago, we saw the Federal Reserve cut interest rates. Well, when that cut happened, that was already kind of expected in the mortgage interest rates. So they already kind of dropped. In fact, they dropped to their lowest levels in 12 months on the day the Federal Reserve announced that. Now, shortly thereafter, interest rates kind of ticked back up a little bit, because when the Federal Reserve makes an announcement like that, when we have clarity in the mortgage space that we think there's going to be a rate cut, the rates already start to fall. And so what we're watching right now is the next move by the Federal Reserve. Some experts are saying the Federal Reserve is going to cut rates by another 2 times this year. Others are saying maybe they don't cut at all. And so until we get clarity on that, interest rates are kind of in this like holding pattern right now. As soon as we get more data that comes in, a lot of data is being held up too because of the government shutdown that's happening right now. But as we get more data that comes in, that will give clarity to where interest rates are going to go, essentially what the Federal Reserve is going to do with their next move, then we should start to see interest rates drift lower. I don't think it's from an interest rate perspective, it's not an if interest rates go lower, it's more of a when. So hopefully we see some movement this year before we wrap up 2025. Now, as a consumer, when you hear the Federal Reserve is going to cut interest rates, you've kind of now learned a little bit about what mortgage rates do in anticipation of that. The date the Federal Reserve cuts rates, though, it will directly impact rates on the auto space and financing, credit cards, probably some of the savings accounts that we're participating in, things like that. All right. Now, looking back 20 years ago in interest rates, honestly, they look a little familiar to what we see today. Home prices were a fraction of what they are today. But I want you to take away from kind of looking at this graphic is that interest rates do cycle over time. And so when we have major crises in the economy, like the housing crisis of 08 and 09, we have the pandemic in 2020, 21, that's when we see interest rates obviously make changes. Now, I bring the kind of the pandemic levels of interest rates to our attention in class because a lot of people are still holding off for the 2.5% interest rates to reappear. Probably not going to happen, because if that happens, something catastrophic again has happened globally. Average interest rates historically are going to be in the high fours to low fives. That's just kind of what we see in normal levels. Everybody wants the perfect rate along with the perfect price, right? Trying to get that is very daunting. It's probably not going to happen, but I think it's important for us to decide when is the right time for us to enter the market. Are we in a good spot savings wise? How does our credit look? Does the budget that we create for you, does that work for you and help facilitate an affordable home purchase scenario for you? So those are all things that we'll talk more about in tonight's class. But when we think about interest rates, there's different characteristics that go into interest rates. Things like credit score, of course, and eligibility of a product, the type of product that I want to select, how much I'm going to put down, and how much do I want to finance. And then when a buyer is selecting their financing options, they can pay additional expenses. We call those points to bring down their interest rate. Generally, 1 point is the equivalent of 1% of my loan amount, and it usually drops your interest rate about 0.25%. Now, I don't recommend buying points unless you really have to in today's market, because most clients, as I mentioned earlier in class, are probably going to consider refinancing when the time is right. So it usually takes about 3 to 4 years to break even on points investments to make sense financially. So I don't really recommend doing that. Now, loan term can also influence my interest rate. So usually the shorter my term is of my loan, the more improved my interest rate is going to be. Now, you're going to hear me talk about consultations in tonight's session, which is where I do a one-on-one virtual session with you to help you design your home buying plan or your blueprint to home ownership and achieving your goals of home ownership. When we meet with you for a consultation, we're going to figure out like what that needs to look like for you in terms of the setup of your loan, the term, interest rate offering, which products match best for you. All right. Now, as we kind of move along in our discussion tonight, I want to talk a little bit about credit. Credit is one of those areas of opportunity that we can kind of like take a look at a little bit closer as we're preparing for home ownership. So I want to kind of dive in a little bit deeper here in class and give you some tips and resources around credit. Now, every loan program does have a minimum credit score, and you can see some of those programs listed on screen here. We're going to spend some time talking about some of those programs in a little bit more depth. But as you know, there are 3 different agencies, or I assume you guys know that there's 3 different agencies for credit reporting. There's Equifax, TransUnion, and Experian. Each one of those agencies has different risk models that they use. That's why you see different scores in your monitoring services. Now, we always take the middle score of all 3 of those reported scores. So if my highest score is 740, let's say my middle score is 720, and my lowest score is 700, then we're going to take the 720 score as my qualifying score. Now, if I'm going to apply with my partner, but let's say my partner has slightly lower scores, they're 700, 680, 660, well, we're going to take the 680 score, which would be the lowest middle score between both of the borrowers. Now, that's important because that can influence your loan program, how much you have to put down for your qualifying of your mortgage, also can change your interest rate and mortgage insurance. Now, there are 3 different models to credit. Credit. I think we went offline here. Oops. Okay, hopefully you guys still got me. I think we might have had some tech issues here. Okay, give me the thumbs up if we're still good there. We're still good. I think we had a little bit of a power outage on one of our. I think we're still live. I think we might have just had a camera issue. So you guys, I think the audio is still going here. So I think we're still good. Okay, I think we might have just lost. I think I still got camera here, but we had a little bit of an outage on one here. But I think we're still good. So we'll kind of keep it moving. Let me just kind of backtrack a little bit. There are 3 different models to credit scoring. So there's an auto financing model, there's a mortgage model, and there's a credit card model. So for those of us that do monitoring with our bank, for example, they're probably giving you a credit card model. And then, in auto lending, there's the auto financing model. And then from a mortgage perspective, that's the one we're going to use as the mortgage model. So that'll determine what things look like for us in terms of what the score is that appears. All right. Now, when we think about credit, we're always going to be looking at, from a lending perspective, the most recent 12 to 24 months of our activity. So if I've had a late payment challenge in the last 12 to 24 months, that's where I'm going to be really impacted in my score. Now, as I move past that event, so let's say, for example, I had a late payment on my student loan. I totally missed it. October 20 of 24, right? Now, as I move past that date of that late last payment, it's probably hurting me pretty significantly right now. But as I move past that date into maybe the past 12 months, and I move past 24 months, then I'm going to start to see organic improvement in my credit score. All right. Let's kind of just kind of keep it moving a little bit. I want to kind of talk to you a little bit about how long negative items will stay with you on your credit report. So when we think about that late payment that I just kind of gave you in my example, it'll have an impression on your credit bureau for 7 years. But to my point earlier, the timeline that's going to most impact you is in the most recent 12 to 24 months. All right, so that's where we're going to see it really impact the credit score. Now, other events like maybe if I had a bankruptcy or a collection account, it might last longer, but generally late payments would be on my credit report for at least 7 years. All right. Now, this is what the FICO model looks like. So when we think about the weighting of the credit model for mortgage, this is what it looks like. I want to kind of take us along this wheel, if you will, of what the areas of opportunity might be for you in your own individual credit score. So if we kind of start here, 15% is going to be how much new credit am I, or sorry, let me back up for a second. It'll be how long have I had my credit open? So if the longer my credit file has been available, the better my score is going to be. If we took someone that had, say, 6 months of credit history versus someone that had 6 years of credit history and put them side by side, the person with 6 years of credit history, all things being equal, probably has the higher credit score versus someone that had a lesser amount of time with their credit. Now, as we kind of continue to move around, we have the in use in credit. Now, that's essentially how many new accounts am I trying to open up, especially in that most recent 12 to 24 months. That is going to impact me there. Now, we really want to avoid opening up new accounts because that could kind of pull back our credit score a little bit. Now, when you open a new account with a creditor, they are going to do an inquiry of your credit. We call that a hard inquiry. Now, hard inquiries can impact your credit score, so we want to be really cautious in how many inquiries we do. Now, there are rules in place for both auto financing and for mortgage financing that state that you can apply with as many lenders in a 30-day window of time, and that's the equivalent of one credit inquiry hit to my score. Okay. Now, our process is a little bit different because we primarily work with first-time home buyers across the country. So we actually only do a soft credit check when we help our clients initially for their pre-approval session, because we want to make sure we provide them, proper guidance, understand a little bit more about their credit, and design a blueprint to home ownership, but not impact their credit score. So we always start with a soft credit check. Now, as we continue on, 30% is probably going to be one of the biggest areas of opportunity for us, which is around credit utilization. So we're simply looking at revolving accounts and comparing what my credit limits are versus what my credit balances are. And, ideally, we want to have those balances at 10% or less of the credit limit amount. Now, let's say I maybe had some recent charges that elevated my credit balances up a little higher than expected. So let's say I had an unexpected emergency I had to pay for, and now my credit balances are at $8,000 and I have credit limits of $10,000. Well, right now I'm at 80% utilization, so I probably saw some pullback in my credit score. My first action item recommendation to a client would be, let's get below 50% utilization of credit. That'll start to uptick our credit score again. Now, as we get to that level, then we want to move to 30% utilization, so a $3,000 balance, and then get below $1,000 in outstanding balances on that credit card. When we see clients that have 10% or less utilization, generally they're probably in the high 700 to 800 plus credit scores. Here's a tip for you to help kind of manage your credit card debt. If you have some time, take a look at one of your credit card statements. There's 2 dates on that credit card bill. There's a statement date. There's also a due date. So here's what's important about the statement date. The statement date is basically the date at which the creditor reports out all of your activity for the previous 30 days on that credit card, payments, debits like purchases, maybe you returned an item, whatever the case may be, right? My tip for our class here is try to pay down or pay off that balance before the end of that statement date, before that statement date closes. Because when you do that, you're going to get a lower balance that reports out to the bureaus, therefore improving your utilization of credit, and then, of course, lifting your credit score. So that's kind of how we would want to approach paying our credit card debt. Last section is going to be payment history. That's pretty simple. How have I paid my credit card debt? I gave you the example of a late payment on a student loan back in October. Let's say that was a 30-day late. That is obviously impacting my credit score. If the late is more significant, like 90 plus days delinquency, that's going to have a bigger impact on my score. So late payments are rated as 30-day lates, 60-day lates, and then 90 plus day delinquencies. All right. Now, as we kind of continue with the theme of credit, I do want to talk really briefly about student loans. There's probably a day that doesn't go by that I don't talk to clients about student loans and how we kind of navigate the waters of student loans and how they impact qualifying for financing. Now, if you're in an active repayment right now, so let's say you have a savings plan for or an income-based repayment program, and let's say you owe $75,000 in debt and you have a payment of $250 per month, well, we can use that payment right away for qualifying purposes. The challenge comes in where we have a lot of clients that are still on forbearance right now. So they just haven't started repayment or they still haven't recertified their savings plan. Or maybe they're back in school and they have a deferment right now. In those cases, unless I have an active repayment going on right now for my student loans, then we count 0.5% of the balances for an FHA loan for the qualifying payment. For a conventional loan, we take 1% of the balances as the payment. So that can change qualifying. So those are conversations I have with clients because let's face it, if I have a $250 payment on my savings plan versus maybe a $750 payment for a conventional loan because I haven't restarted payment, that could change what my qualifying looks like for my home financing. So again, kind of the takeaway here in the student loan section is if you on forbearance or you have deferment, we're going to have to count a minimum payment for qualifying purposes. However, if you're on an active repayment right now on a savings plan, we can use that payment right away. All right. So a question came in. I just want to kind of take this on air. Do you recommend paying off car loans if possible before applying for a mortgage, or is it better to have consistent loan payment history with a similar car loan remaining? So that's a good question because we can go a couple different angles with that. One is I would say connect with me for a virtual session and let's talk about your home buying plan first before we do anything with the car loan. Because when you do pay off a car loan, short term, it can actually lower your credit score, I've seen. Two is when you have 10 payments or less remaining on any type of installment debt, then generally we don't have to count that against you for qualifying for your mortgage. So I always encourage clients before you make any moves financially, and let's say if you're preparing for home ownership, right, especially in the next 3 to 4 months or beyond, and you're going to think about making a financial move, new purchase, opening up credit card debt, paying off a car loan, buying a new car loan or a car, talk to us first because we want to make sure that that doesn't create any obstacles for you in your pursuit of home ownership. All right, thanks for that question. That's a good one. All right, let's talk a little bit about loan programs. And we're going to kind of give you a 10,000 foot view of guidelines to programs, many of which you've heard of these programs. I want to kind of give you some insight to how these work. And then, these are all kind of built around guidelines, especially when we think about student loans. The guidelines that we have to adhere to for student loans are the outputs of what we have to do here in the loan program. So we have 5 programs here. You're going to kind of get a high level look at each one of those. Some of these we access more than others, just based upon where clients match best to. But let's kind of talk a little bit about these. So the first one is a conventional loan. Conventional will be a Fannie Mae and Freddie Mac loan. You're hearing a lot more about Fannie and Freddie in the news because there's talk about taking them outside of the current kind of conservatorship they're in right now with the government and making them private. So there's kind of talk back and forth of whether that benefits the economy or not, or the cost of housing. The minimum down payment for a conventional loan is 3% for a first-time buyer, up to the conforming loan limit, which is being revised right now from 806,500. It's going up just a bit. But ultimately, that is the conforming loan limit. That conforming loan limit changes right around this time of the year for some of the products like our CalHFA first-time buyer product, which you'll learn a little bit more from Leanne in just a bit. That will update at the first of the year once we hit 2026. Now, anytime we go over the conforming loan limit for high cost of living areas like, let's say, San Francisco or San Jose, or maybe you're down south in LA or Orange County, there is what we call as a high balance loan limit, which essentially allows buyers to purchase with more financing, but the minimum down payment jumps from 3% to 5% when we go up to anything above the conforming loan limit. Next product is the FHA product. FHA stands for the Federal Housing Administration under HUD. FHA is a government insured loan with the minimum down payment of 3.5%. Now, the loan amounts will vary based upon what county you want to buy in. And there's lower credit scores as opposed, minimums, I should say, as opposed to the conventional loan. Now, both the FHA loan and the USDA loan are both government insured loans. One is insured by HUD, the other one's by USDA. Now, about 3 to 4 months ago, we did have unfortunately, some guideline changes as it relates to residency requirements for both of these government insured programs. Unfortunately, you do have to be a permanent resident to access both of these programs. Now, you can be a non-permanent resident and access conventional loans, but unfortunately, with the government insured product, you do have to be a permanent resident. Now, with USDA loans, it allows you to buy in more rural areas. So if it's designated as a USDA rural property eligible and you meet the income and household size requirements, that could be a product that allows you to put 0% down to purchase your home. So it's a great product, especially for those, if you're in the Sacramento area, you want to buy in the foothills or some of the areas up north, the Williams area, that can qualify as USDA. Now, the jumbo loan, not totally popular with our first-time buyers, but it does allow you as a buyer to have a little bit more funding capacity, especially if you need to finance above and beyond, let's say, what Fannie Mae and Freddie Mac offer with their maximum loan amounts. And then finally, the VA home loan allows our veterans to have access to home ownership with a zero down payment option. There's really no maximum loan amount for a VA loan, and you can see the minimum credit score requirements on screen. Now, the VA loan has a lot more leniency to support the veterans with entry to home ownerships, things like expenses versus income. We have a little more flexibility there than we would say with other types of loan products. All right, now I want to kind of pivot a little bit. I want to talk a little bit about mortgage insurance. And mortgage insurance is something that comes up in my conversations with clients to better understand mortgage insurance. Is certainly the cost of mortgage insurance. But what is mortgage insurance? Well, mortgage insurance essentially provides insurance to the lender against default by the buyer. So if I went through an economic hardship and I could no longer afford my home and I defaulted on my mortgage, the insurance essentially protects the lender against that. Now, there's two forms of mortgage insurance. There's PMI, which is private mortgage insurance for a conventional loan. And then there's FHA mortgage insurance, which is MIP or mortgage insurance premium, that now provides insurance backed by the government. And so let's talk a little bit about the characteristics of each one. So with PMI, there's about 7 to 8 different companies that insure privately us as lenders for the mortgage insurance. Now, it is paid for by the buyer, and the mortgage insurance is rated based upon different calculations. I should say different elements that go into the calculation. Things like your down payment, your credit score, how much you're deciding to finance. One of the benefits with conventional mortgage insurance is that there is a cancellation option. So once I have 2 years in my loan and 20 to 22% equity, I can apply to have that mortgage insurance canceled. Now, mortgage insurance gets a little bit of a bad rap on some of the sites that you might be searching on, like Zillow or Redfin, because it looks very inflated. But mortgage insurance is based upon credit score, down payment, and amount financed. So when you look a little bit closer at an actual score calculation or a mortgage insurance calculation, it's not as expensive as you might think. So if I financed $450,000 and I had a 740 credit score, my mortgage insurance is about $183 a month. Okay. Now, the higher I can push my credit score, the more I can put down, the lesser that cost is going to be. Now, on the other side, we have FHA. Now, FHA is more fixed in the premium amount. So there's monthly mortgage insurance at 0.55% of my total loan amount, and then we divide that by 12. And then we have upfront mortgage insurance, which is 1.75% of my amount financed. Now, that gets factored into my total amount that I borrow is the upfront mortgage insurance. So it will make the cost of an FHA loan a little bit more expensive. If we took that same 450 amount borrowed, and then what we'll do is we'll add on mortgage insurance of $78.75, so that gets added into the total balance. And then we have the monthly amount of $206 per month, which is the 0.55% of the loan amount divided by 12. So when we look at those two products, the expense structure looks a little bit different. You may be asking yourself, well, why would I consider FHA versus conventional? Because clearly it's a higher payment. Well, when we think about the guidelines that we reviewed a little bit earlier, the qualifying looks a little bit different between both those products. Credit scores look a little bit different. The leniency might be favored more towards the FHA loan versus the conventional loan. Maybe I had that late payment that I'm still carrying with me from last year. FHA is probably okay with that, whereas conventional might be more of a hurdle to get over. So those are things we think about when we product match for our clients to figure out the best option to create affordable home ownership for them. So that's kind of the things we think about. Last thing I want to touch on here is that if you're starting to do searches on rates online, you will see FHA rates are generally about 0.5% lower than a conventional rate. But what you don't see behind the scenes is that cost of mortgage insurance. So the expense structure is so much higher. So, generally with that FHA loan, we're looking to use that as an entry point to home ownership. So if a client does have some credit challenges or maybe some expense challenges, we're going to look to try to have that entry point with FHA as they improve those aspects of their financial profile. looking to refinance long-term. All right. Let's talk a little bit about income for qualifying. I get a lot of questions around like, is my employment eligible? Have I been on my job long enough to be able to qualify for a mortgage? So I want to kind of walk through some different scenarios for you around income. But before we do, I wanted to pass along some of the typical documents that we'll ask for from a buyer that you can see here on screen. So these are generally some of the items that we'll ask for from our clients as we prepare for a consultation with them. So let's talk a little bit about income for qualifying. Now, there are rules in lending that state that we have to verify 2 years of work history, but it also includes educational history. And I think that's a really important component. So I do have to verify that 2-year work history. And so let's say I graduated from Sac State in the first, well, I'll say the spring, right? Spring semester. And now I just started my new job August 1st. Well, I can still use my undergrad work I did at Sac State to make up that 2 years. Plus, the last couple months that I've been on my job starting on August 1st, that can make up my 2-year requirement for financing. So I don't necessarily have to wait to be on my job a certain amount of time. I just have to, as a lender, validate your 2 years of work history. That's including of new prospective jobs too. Let's say, for example, I have an opportunity to take on a new role and I have a job offer, and that job doesn't start till November 1st. In fact, a great example is I met with a client starting a job on November 3rd earlier today. So we actually completed their pre-approval earlier today because we had an executed offer letter for them to start their job next month in just a couple weeks. So they were able to get qualified for their home in anticipation of their move to California. And so you don't necessarily have to have the 2-year work history. I just have to show, or 2 years on the job, but we just have to have that 2 years work history and or education. Now, if I'm self-employed, the 2-year rule is a little bit different because I do have to show 2 years of tax filings to validate that income. And generally we'll average that net income over 2 years to determine qualifying. If I have a variable compensation position, so we see this where maybe I get an annual bonus every year, or maybe I get commissions, or maybe I get overtime because I'm in an hourly position. Now, those are all variable components to my compensation. In that case, we have to show that I've been on the job 2 years to factor in that income, because as an underwriting team, we're going to average those variable sources over the last 2 years. That would also include some of our clients that are in tech that have, maybe they're working for Google, for example, and Google awards stock grants, RSUs. If we want to count those into the income calculation, then we would need to see that that client has been with that institution for at least 2 years, all right? And then when we have multiple sources of income, so let's say I work for 2 different employers, let's say I'm in the healthcare field and I work for 2 different clinics, I do, in that case, if I want to count both sources, have to be on the job for 2 years with both sources of income. All right. And then last thing I wanted to kind of talk a little bit about is other sources of income, because sometimes we'll have clients that will apply with us and their partner is contributing to the household from an income and expense perspective. However, they're not going to be a part of the loan application. So in that case, I can't count that income unless they're going to be a part of the loan application with us. All right. Now, as we look at income, we're going to go through a calculation and figure out what your eligible income looks like, but we also compare that against expenses that you have in your existing household or on your existing credit report, essentially. We also factor in projected expenses for your new housing payment. So we've taken into consideration the principal and interest of my new mortgage, how much the property taxes are going to be on my house, what my homeowner's insurance is going to be. If I'm going to buy a condominium, for example, I'll factor in homeowners association dues. If I'm putting less than 20% down, we have mortgage insurance. So all that gets factored in as expenses, along with my existing credit card debt, maybe my student loan payments, my auto financing, all that gets kind of baked in to my total expenses. And then we divide that by our pre-tax income. So here's a scenario here on screen that you can see. So we have someone that's going to be paying $2,500 in housing expense. They have $500 in existing expenses, and then they're making $8,500 a month. So in that case, this debt to income ratio calculation shows me that 35% of their pre-tax income is going out to those expenses. Now, clients ask me all the time, Jason, what should my debt to income ratio be? Well, the sweet spot that I found in working with hundreds of first-time buyers is usually about 33 to 36%, but the guidelines allow us to go up to as high as 45 to 50. Those are conversations we're going to have in your virtual consultation with us to figure out if that works for you, because at the end of the day, we're looking to try to create an affordable home buying plan for you, something that works for you. So $2,500 is a month on a mortgage feels okay for you, that's where we want to land. Because if $3,000 we can qualify for it, doesn't necessarily mean that that's where we want to hit the target for when it comes to affordability. All right. Now we're going to talk a little bit about, I know we're kind of moving through this, but feel free if you do have questions, don't hesitate to drop the question in the chat. I'm monitoring that as well as the Q&A. I'm kind of checking those out as well as my colleague Ken is doing the same. Let's talk a little bit about savings for home ownership. And that's our last component of preparing for home ownership. And then, of course, understanding the workflow of buying a house. Now, savings can be one of the bigger challenges for some of our home buyers. And Leanne's going to share with you a little bit about CalHFA and how they're instrumental in kind of closing the gap for our first-time home buyers in California. But I want to kind of share with you a little bit about savings and how we prepare for that, but also some of the documents. Let's first talk a little bit about what we generally validate when it comes to savings or assets, I should say, for home ownership. So we do, of course, verify checking and savings accounts. Cash cannot be used in a real estate transaction unless we have to have a seasoning period of at least 60 days of that asset being in your accounts. Now, I get a lot of questions around, is digital currency valid in a home purchase? Unfortunately, crypto is not allowed at this point. In order to exercise that type of currency, you're going to have to sell the currency and then have it live in your checking and savings account for 60 days seasoning, and then it could be potentially used. For retirement accounts can be used, 401ks, 403bs, 457 accounts. Those are potentially allowed. I always tell our clients, talk to your financial or tax advisor first before you access those assets to make sure you're putting yourself in the best financial position. And gift funds can also be used for our home buyers. Now, gift funds don't require a seasoning period, but there is a documentation kind of workflow that we go through to validate those gift funds. Now, let's talk a little bit about actually preparing for homeownership around savings. Now, this is a really simple approach that I coach clients through in our virtual sessions, which is to take a look at what am I paying in housing today? What do I think I can afford in housing? And how do I build a better nest egg, if you will, for savings? So, for example, if I'm currently comfortable in paying $2,000 a month in rent, and I know with my new job that I just started in August, I can afford $3,500 a month, but I haven't quite saved up enough. What I would encourage our clients to do, let's start saving like we're making that mortgage payment today, right? So here's what that means. November 1st, I got to pay my $2,000 rent, right? When I pay that $2,000 in rent, I'm also going to carve out another $1,500 out of my check that's going to go right to my savings account. As I do that on a month in, month out basis, I am now generating more savings for myself, right? Now, I'm also building that savings up. So at the end of 6 months, I have $9,000 accrued. By the end of 12 months, I have $18,000 accrued in my savings account. Now I'm really getting some traction in savings. It also creates that discipline that as I pay on the first of the month, I've grown accustomed to paying that $3,500, $2,000 to my landlord, $1,500 to my savings. So when I transition to home ownership, doesn't feel like a big payment shock for me, right? I've been doing it for so long. So that's a great way of creating the discipline of getting accustomed to the $3,500 or whatever number we designate on a monthly basis, getting comfortable with it, also generating savings for home ownership. Now, first-time buyer programs like our offerings through CalHFA can be an amazing opportunity to, like I said, close the gap for what we need to purchase a home. So we asked Leanne Walker from CalHFA to join us for tonight's class. CalHFA, Leanne's a great friend of mine and a partner for us at CalHFA, and I'm so glad that she could carve out time out of her Thursday schedule. I know she'd probably rather do other things on a Thursday night, but we appreciate her joining us for tonight's session. So I'm going to give the floor to Leanne and let her talk to you a little bit about what CalHFA does to support our communities.
Okay, thank you, Jason. Good evening, everyone. So again, I'm Leanne Walker with CalHFA.
Leanne, you okay on your end?
Can you hear me? Are you able to hear me?
Okay, we're waiting for okay, we got
yeah.
Leanne. We did have okay. All right, I have no audio on my side, so Leanne, I'll let you take it away.
Okay. So CalHFA is a state agency. So we are the state of California. And we were created to provide help for people to be able to buy a home. So to get our programs, you don't apply directly through us. You go through one of our approved lenders. So Jason is one of our approved lenders. So you would apply directly through him to get access to our programs. So we currently have three programs. So our MyHome program is going to cover your minimum down payment. So it will give 3% on a conventional VA or USDA, and then it gives 3.5% on FHA. So like Jason was going over the different first mortgages. So FHA requires 3.5% down payment. Our MyHome will cover that full 3.5% down payment for you. And then on a conventional, if 3% is required down, MyHome will cover that full 3% down for you. So you wouldn't need to come in with any down payment at all, unless you wanted to. So MyHome is flexible to where you can combine any amount of your own money with the MyHome. So you could either leave your money in the bank and then use our MyHome to cover that minimum down payment. We see a lot of people do that because when you buy a home, what's the first thing you're going to want to do? Buy furniture, or make some repairs, or, paint the walls or anything like that. So some people will, even if they have saved up some down payment, they may decide to leave that money in the bank to make those upgrades to their home and then just use our MyHome to cover their minimum down payment. Or you have the option to combine your money with our MyHome to get a bigger down payment. That could do one of two things. That can increase the sales price that you qualify for, or it can help lower what that mortgage payment is. So like Jason just covered, when he qualifies you, go over what your payment will look like. And if you're like, oh, that payment's a little bit too high, then a bigger down payment will help with that. So MyHome does all of that for you. But MyHome is a loan. So it's not a grant. You do eventually have to pay this back, but it's silent. So there are no monthly payments. You pay this back when you sell, or if you refinance, or in 30 years, whichever comes first. So our hope is when anyone buys a home is that you build equity. And our hope is that when it is time for you to pay this loan back, you have built up enough equity in your home to use the equity to pay it back. So like Jason was mentioning, the rates drop, you may want to refinance, get that lower rate. You would pay back the MyHome at that time. But if you have enough equity, you could just use that to pay it off through the refinance. It does have a low 1% simple interest, so interest is accruing. So like the example on the screen, if you got 15,000, 1% of 15,000 is $150. So every year, your balance will increase by that same $150. Again, payments are not required, but you can make payments at any time. You can pay this loan off at any time. There's no prepayment penalties. Now, in addition to down payment, you also have to come in with what's called closing costs. And it can vary loan to loan. Now, average we see with our loans is about 3 to 4%. Sometimes it could be a little bit less. Sometimes it could be a little bit more. But that's a kind of average for what we see. So we have two additional programs that you can add on to the MyHome to cover your closing costs. So our ZIP program will give 2, sometimes 3%. Just depends on the rate. Sometimes we may not offer the 3%, but a lot of times it's 2 or 3% that will go towards your closing costs. So you would add this to the MyHome. So the MyHome would cover your minimum down payment, and then ZIP would cover a good portion of your closing costs. So it's probably not going to cover all of your closing costs, but it will cover a good portion of it, leaving you with very little that you have to come in with. ZIP is just like MyHome to where it is a loan that you do eventually have to pay back when you either sell, refinance, or 30 years. But ZIP has 0 interest, so there's no interest on this loan. And then our newest program, it's been out maybe about 3 or 4 months. It's our MyAccess program. This one gives you 2.5%. And this one you can use for closing costs or additional down payment. So wherever you need it. So say you have your own closing costs, but you want that bigger down payment, you can use MyHome and MyAccess together and put it all for down payment. And this is where Jason will come in and help you because he can run scenarios. So that way you can see what it looks like and which option is going to work best for you. So MyAccess, again, is a loan just like the other two, has the same 1% simple interest as MyHome. Again, it's going to be due and payable when you sell, refi, or 30 years. You can only put two of these together. So you're going to really have three options. So the best option to get the lowest interest rate that we offer would be just to do our MyHome, and then you would come in with your own closing costs, or you could work with your realtor to see if the seller's willing to give you a credit, because sometimes the seller may give you a credit to help cover your closing costs. Now, say you don't have the money, the seller's not willing to give a credit, then that's when you would look at adding either the MyAccess or the Zip. So it does increase your interest rate on the first, so you will pay a little bit higher interest rate. So that's why I was mentioning MyHome by itself is going to give you the lowest rate that we offer. But if you did need that additional assistance, then that's when you can add on the MyAccess or the Zip. Again, it will increase the interest rate on the first a little bit. But again, Jason can run those scenarios for
Yeah.
you
So,
and see what options work best for you for that. So we do have a couple requirements to get our loan. So you have to get their approval from the lender. So Jason will make sure you meet FHA or Fannie Mae guidelines depending on which loan you're doing. We do require a 640 minimum credit score for any of the government loans. So FHA, VA, or USDA. And then we require a 680 if you're doing conventional. We will go down to a 660 if you are low income, which is 80% of the AMI. And Jason will be able to figure that out for you to see if you meet that low income. Our max debt to income ratio is 45% if you have under a 700 credit score, but we will go to a 50 if you have a 700 or higher credit score. We do require that you are a first-time home buyer. Our definition of a first-time home buyer is someone who hasn't owned their primary residence in the past 3 years. So it's not just someone who's never owned before. You could have owned before. If it's been 3 years, you are considered a first-time home buyer again. And we even go a step further, saying long as you haven't owned your primary residence in the last 3 years. So you could have a rental property. So you could own a home right now, but maybe it's an investment property. You rent it out. Long as you can prove you've been renting where you live now for the last 3 years. So you just have to prove you do not own the house you live in for the last 3 years. And then we do require that you are buying a single family, 1 unit property. So you can't buy a duplex or 2 to 4 unit on our program, but you can buy a condo or a townhome. We even allow if the property has an ADU, so an accessory unit. A lot of different names we call them: granny flats, in-law quarters, guest houses. As long as that appraisal comes back saying it's a 1 unit with one accessory unit, so it can't come back saying it's two separate units. And then we do allow manufactured homes, but it has to be a true manufactured home, means that it's permanently affixed to the land and you own the land. So it can't be like a mobile home in a park where you pay space rent. We also require that you go through home buyer education because we want to make sure you are educated home buyers. Our goal is to help you get into a home and keep you in the home. So we want to make sure you are mortgage ready. And Jason will, get you all set up with that. You have a couple options. You can do online through a company called eHome. We have a specific link on our website for that one. Or you can choose to do in person or virtual through any NeighborWorks or any HUD approved 8-hour course. We only require one borrower on the loan to go through the counseling. So if two of you are buying together, you can both take it. We're just trying to keep the cost down for you because they do charge per person because these do cost money. Every once in a while, you may find one that's free, but majority of the time they are going to cost money. The certificate is good for 1 year. So we do recommend that you take it very early in the process. So we recommend soon as a lender pre-approves you, you should be taking the homebuyer education course. That way it doesn't hold up your closing. A lot of times people wait till the last minute And then now you're trying to close on your home and you're not going to be able to close because you haven't completed the course. So make sure you do take that early. And then we also require that you get a 1 year home warranty. Now, 9 times out of 10, the seller will pay for this for you. It's not a guarantee, but majority of the time they will. This is something you'll work with your realtor. And then Jason will work with your realtor as well, letting them know, hey, they're doing CalHFA. We need a home warranty. Let's see if the seller can pay for it. So this kind of ties into the home buyer education because the home buyer education is going to go through the whole home buying process. They're also going to go through budgeting. It's very important when you own a home that you budget. So if you're renting right now and something breaks, what do? You call your landlord, right? They come and fix it. But when you own the home, you are now your own landlord, so you have to get it fixed.
Yeah.
So that's why we have this 1 year home warranty requirement. So it's separate than homeowners insurance. Homeowners insurance covers the structure of your home and it's mandatory for the life of the loan. So that's going to cover if your house catches on fire. Home warranty covers your systems and appliances. So it's going to cover your HVAC system, so your heating, your air conditioning. It's going to cover your plumbing, your electrical, your built-in appliances like your stove, your oven. So if something breaks, it kind of takes the place of your landlord. So something breaks, you call your home warranty company. They will send someone out to fix it. You just pay your service fee. So it's basically like a deductible, like you pay a deductible on your insurance. So it can vary based on what plan you get, but I've seen them anywhere from like $85 to $125. So say your plumbing goes out. They'll send a plumber out. Say the bill was $2,000 and you have an $85 service fee. All you pay is $85, not the full 2000. So we only require it for the first year. We do waive it if it is new construction. But like I said, majority of the time you can get the seller to pay for it. And then our last requirement is income. So remember, we're the state of California, so you can buy anywhere in the whole state on our program. So the limits are on the screen now for some of the counties close. So since we're
Yeah.
in Sacramento right now, you can make up to 225,000. And that's going to be for Sacramento, Placer, Yolo, El Dorado. And then if you're going to Solano, 222, San Joaquin, 198. So you can go on our website and get a list of all of the counties and the income limit. And we only count the income of whoever's buying. So the purchasing borrowers. We don't count household income. We only count who's buying. So if two of you are buying together, then both of your incomes combined cannot exceed this. If only one of you is buying, then we only count your income. And we use the same income that the lender uses to qualify you. So as soon as Jason qualifies you, he's going to know right then and there if you meet our income limits or not. So you can see our limits are actually pretty high to
Yeah.
be a low to moderate program. So you can make a good amount and still get down payment and closing cost assistance. And then the last thing I want to mention, our Dream for All program. You may have heard of that. We did get funding for next year, so that is going to be coming sometime early next year. We don't know the exact date yet, but it could be January, February, March. We don't know yet, but it will be coming early. So if that is something that you're interested in, just go ahead and talk to Jason. And then that way you can start getting prepared if that is a program that you may be interested in.
Perfect.
So I don't want to take up too much more of your time,
No,
but
that's
if there's
awesome.
any
That's great stuff.
questions, I can answer, Jason.
We did get a question. I can't answer it individually for the person, but so one of the things that Lan touched on is income. So we look at gross income when it comes to any lending product, not specific to CalHFA, but we always look at gross income for wage earners. If you're self-employed, then it's net income because we look at whatever's left over after all our expenses to the business. So, but yeah, any other questions for Leanne that she can help with? Uh, Awesome. Well, and thank you so much for giving us a highlight there, and of course, kind of, sharing with us about the Dream for All. I know a lot of the communities are excited about that. We still don't have the exact date, but like Leanne mentioned, early 2026. As we get more details about the program, we'll be broadcasting them out to our community. But that is obviously a huge opportunity for those that can participate and have eligibility and get selected. So we'll stay tuned for more details on that.
Yeah, and you can sign up for our e-news on our website. That way you'll get notified as soon as we put any information out.
Yep, perfect. That's awesome. All right. Well, good deal. I appreciate all the information. For the rest of our class, we're gonna wrap up with just the workflow of buying the house. And Leanne, you're more than welcome to kind of stick around, but you know it just as well as I do. So if you want to go enjoy your Thursday night, feel free to do so.
Okay, have a good night,
All right.
everyone.
See you, Leanne. Thanks so much. All right. Well, good deal. I'm glad she could join us. So let me just give you a quick, I know we're right at the top of the hour. Let me just kind of share with you the buying process. Because as I meet with clients, they want to know, especially after our classes, like, where do we go from here? Well, we have a really simple 6-step process to buying a house. And leaving a class like this, we'd encourage you to get connected with me for that virtual session that we talked about. It does start with a couple action items on your side of it. So it's about doing an online application. We do have to do a soft credit check. That does not impact your score at all. Then you'll upload documents, and then you'll use our scheduling system to schedule a 30-minute virtual session with us. And that gives us an opportunity to build the home buying plan for you. Now, the output of that plan or the consultation is to get pre-approved for one of the product offerings that we have, whether it's a standard program or maybe one of the CalHFA assistance programs. And so even getting prepared and pre-approved for the Dream for All program that Leanne mentioned to you as well. Now, once you're pre-approved on a program, you can then start your house hunting. And the house hunting could be one of the longest stages in the process for some of our buyers, depending on what community we want to buy in. It generally will start online. And then as you kind of identify areas that you want to purchase in, I would encourage you to talk with a local realtor. They should be experts in that community, understand, how to negotiate the proper home purchase for you and make sure that it's a great investment or just option for you right now. As you go out and do the house hunting, you're going to be looking at multiple properties, and then you're going to probably identify the home that works for you. And then you would submit an offer to a seller. Now, if the seller accepts that offer, and by the way, it's not going to probably happen on the first offer, but it could. If that offer gets accepted, then you're going to have a ratified agreement with the seller. Now, the same day that happens, you're going to get a call from me saying, hey, congratulations, you did it. You have an accepted offer. Let's talk a little bit about next steps, and let's schedule you for your virtual session so we can go through all of the elements of your mortgage financing. Now, you're also going to have some action items on your side of the table, which is to make an earnest money deposit when your offer gets accepted. Usually you make that deposit within 1 to 2 days, maybe 3 days of the accepted offer. And the amount of that deposit is usually 1 to 2% of your total sales price. Now, that earnest money deposit does count towards your total out of pocket for the home purchase. So when we think about down payment and closing costs for our home purchase, that deposit will count towards that. Now, that deposit is protected by an aspect in the contract called a contingency period. In all purchases in California, if selected, there is a contingency period, which gives you a timeline to do some research for yourself on the property. Things like getting the house appraised, which I would handle as your lender, to ensure the home is worth what you're buying it for. Get your inspections done, maybe get the roof inspected, get the sewer inspected. Your realtor will help facilitate that. And then finally getting your loan approved. Contingency periods usually run from 7 days to as far out as 21 days. But it allows you that protection as a buyer to do your homework on the house. And that deposit is protected until you lift those contingencies at the end of that time period. Now, as we move through the workflow of buying a house, step 4 is kind of the administrative functions of buying the home or the processing of the loan, which would include verifying your employment, your credit, your assets, making sure everything is kind of structured properly in your loan. Now, as we move through these different milestones, after we finish doing a follow-up virtual session with you, within a couple days of your accepted offer, you're going to be getting disclosures from us. You'll get your initial disclosures within 72 hours of that consultation. You'll then get another set of disclosures once we lock in your interest rate. And then finally, within 3 days of closing, you get your final closing disclosure. Now, As we get an accepted offer with the seller, we're now going to start having some strategic conversations around interest rates and when we lock in our interest rate, because interest rates change every day throughout the trading day in the economy. And so we really want to kind of strategically watch what's happening in the market for you to be able to help seize the best opportunity for you when it comes to interest rate. Now, if you're looking specifically at like the CalHFA programs that we talked with Leanne about just a little while ago, CalHFA sets the product rate every day at 8 a.m. for each one of their products. Now, step 5 is loan approval. That means we have your loan approved. It's generally about 2 to 3 weeks in the process, because traditionally from step 3 to step 6, it's about 30 days, but it can be as short as 14 days, believe it or not. So that these timelines of milestones will vary based upon how fast or slow your contract is. But at step 5, we'll have our loan approval. That also triggers us to initiate your final closing disclosure, which gives you a 3-day cooling off period before we get to the final stages, which is the closing of the home loan. Now, at step 5, you're more than likely going to be at the end of your contingency period too. So as long as everything checks off with your inspections, your appraisal, and your loan, then you would be able to go ahead and sign off on that contingency. That tells the seller basically you're ready to move to the closing of the transaction, which at that point, you're going to be signing final loan documents in person with a public notary. You'll then be required to wire transfer or deliver a certified funds for the remaining funds owed in your transaction. As your lender, we're going to go ahead and wire the funds in for your home financing and any type of assistance programs that you elect. That money gets all balanced out with an escrow team, and then they record final documents with the local county recorder's office. So they'll record a transfer of deed called a grant deed from ownership transfer. Then they record a deed for the mortgage. And once all that gets confirmed as recorded, then we get a chance to give you the kind of the most enjoyable call, or our favorite call of the day is to say, hey, congratulations, you did it. You are now a new homeowner. It's such a huge accomplishment. We had one of our clients down in San Luis Obispo County that got their keys to their house today, and they've got movers set for 2 o'clock tomorrow. And it's such a joy for me to be able to help make that goal come true for them. And it's such a huge opportunity, a huge financial milestone for our buyers, a lot of which those relationships starts in classes like this. Now, our relationship with our clients don't end when they get the keys to their home. We have our aftercare that makes us stay connected with our clients. We want to make sure that we're obviously managing rate opportunities for you even after you buy your home. So when it makes sense to refinance, we have you in our rate watch system. We have our HomeBot system that helps you kind of manage your home equity with tools that are offered through that system. And then we're always checking in with our clients every year, because let's face it, things change for us financially. And so we want to always make sure that we're here as a resource for you in your home ownership. Now, as you're thinking about starting the process, and hopefully you are, here's a kind of a simple way that we kind of get started in the process. It starts with an online application. There is some documents that you'll upload, and then you'll use our scheduling system, which you can see here, to schedule your virtual session with me. And that's where we have the opportunity to connect for 30 minutes and just kind of figure out, like, what's this need to look like for you? What's your goals and objectives for home ownership? And I always encourage clients, when you do a consultation with me, it's not like the expectation of let's go buy a house this weekend. It's strategically planning for either the next 2 to 3 months, or maybe even the next 2 to 3 years, whatever your goals look like for home ownership. Here's kind of what that consultation service looks like. It is a free service we provide to our local communities just to help prepare you for home ownership. And as I get towards the end of class, I know we're running a little bit over time. I do want to point out one of our technology tools. That's our mobile app. It's a great way to start the application process, but you can also follow the progress of your loan and use some of the calculator features within mobile. We really embrace technology as part of our team. However, doesn't replace the human touch of our business. We understand this is the number one financial or biggest purchase you're going to make financially. So the human touch is a really important element, whether that's the call that you need, email, or just a text just to kind of check in with us. We're always helping support you during that home buying process. As we wrap up our class tonight, I just wanted to point out one of our discounts that we offer to our Sac State alumni and local community. It really discounts our closing costs by $750 to make homeownership just that much more affordable for you. But we also have other partnerships all across the country that we help serve in affordable homeownership and provide classes just like this. So if you have friends, family, maybe some coworkers that might be interested in a class like this, feel free to pass them along some of our upcoming class schedule. You can find that all at mortgageeducate.com. And again, we've recorded tonight's class, so if you want to share that link back from our YouTube channel, with friends, family, coworkers, that's great. Or obviously kind of take a look back at some of your notes from today's session. Here's all of my contact information. So if you want to reach out to me after class, feel free to get connected with me. And finally, we love what our community says about us, and how we serve in homeownership. We understand, really how big of a role we have in helping you achieve your home ownership goals. So we'd encourage you to kind of check out what our community says about us, whether it's in Reddit, whether it's on Google reviews. I mean, we love to hear what our clients say about us, and we like to celebrate home ownership on our social channels as well, like Instagram, sharing testimonials, but experiences and value to you. So feel free to follow us if you like on some of our social platforms. All right, well, that takes us to the end of class. I appreciate you being a part of tonight's session. I hope I get a chance to connect with all of you. I am going to stick around a little bit longer in case we do have some questions from the group. So you can drop those in the chat or the Q&A, and I'll answer those on air. And again, we're going to share back all of our presentation material tomorrow morning with you. All right, any questions from the group that I can help answer? Now, everybody's been sticking around too, so we got a great class that stayed right past the top of the hour, so I do appreciate that. Anything I can answer for the group before we wrap up? Okay, so one question came in is, can you explain a little bit more about the initial deposit? So I think that was a question around the earnest money deposit. So an earnest money deposit is the initial investment you have to make once you have a ratified contract with a seller. So like I mentioned earlier, it's usually 1 to 2% of the sales price, but it does get factored in to your total out-of-pocket expense. So it basically goes into what we call an escrow holding with an escrow company. That money stays there and then gets credited towards your remaining cash to close at closing. But the contingency period is a big part of that too, because that protects the deposit while you go through the home purchase process. All right, thanks for that question. All right, you're absolutely welcome. All right, very good. Okay, well, I think we did it. Thank you so much for being part of tonight's class. We do have other classes on the calendar for the rest of the year. Leanne mentioned a little bit about the Dream for All launch in 2026 or early 2026. I am going to be teaching a live YouTube class next month to talk a little bit about learnings from past Dream for All that we were a part of, and what the guidelines look like and overall eligibility, and just be taking questions live on air from our community all across California. So look for more details on that. You can see our class schedule for that as well as others at mortgageeducate.com. All right, have a wonderful night. Enjoy the rest of your week. I'll talk to you soon. Good night.